Welcome to the Stock Market Palantir. Today, we are going to talk about a very interesting name, CrowdStrike. That's CRWD.
Yeah. And our focus is really on its, let's call it complex financial performance and the highly charged market dynamics surrounding the company. This whole conversation is really sparked by their latest numbers, the fiscal year 2026 third quarter results that dropped on December 2nd, 2025.
Exactly. And this material, it forces us to grapple with a classic tension you see in these high-growth stocks.
Right. So the central question, and really the specific disagreement we want to get into, is whether CrowdStrike's, frankly, profound premium valuation and the extreme momentum we've seen is actually justified by this incredible, re-accelerated growth story.
Or if the recent price action, all that volatility, is really just a product of, non-fundamental market microstructure forces. Things like leverage and options.
Precisely.
From my perspective, the fundamentals are the overwhelming driver here. They provide the foundational bedrock for the stock's current price. CrowdStrike's Q3 results delivered what I can only call statistical outliers that fundamentally validate their whole strategy. They've definitively reestablished themselves as the preeminent consolidator in cybersecurity. They've decoupled from that whole software slowdown narrative we're seeing everywhere else.
And see, I come at this from a different angle. Well, I absolutely acknowledge the exceptional quality of the business metrics. You can't argue with them. I'd argue that the price of the stock is dictated by external factors, things far beyond the operating metrics. And that exposes investors to some pretty severe multiple compression risk. CRWD is priced for a level of perfection that it ignores a lot of complexity. The risks embedded in its market structure are, I think, the primary source of all this recent, sharp volatility.
Okay, well, let's begin with the quantifiable evidence, the evidence that I believe supports that premium valuation. The headline metric that stunned the market was this unprecedented re-acceleration in net new annual recurring revenue, or NARR. It hit a record of $265 million. Now, that marked a staggering 73% year-over-year increase. In a software environment where nearly every major player is struggling against macro headwinds just to keep growth above 20%, a 73% acceleration is not merely strong. It is a statistical outlier, and it serves as a powerful leading indicator of sustained, aggressive market share capture.
Okay, I see why you'd rely so heavily on that number. I really do. But let's try to bring that performance back down to the harsh reality of the market price tag. That valuation is where the wheels start to come off for me. You're talking about a company that trades at an extreme valuation of approximately 28 times its trailing 12-month price-to-sales multiple. Now, to put that in context, you have to compare that multiple to a strong, profitable competitor like Palo Alto Networks, PANW, which is trading closer to 14 times. The primary risk here isn't operational failure or even a moderate slowdown. It's a sudden, structural re-rating back toward its pure multiples. That implies a potential downside of 35 to 40%, and that's before we even consider broader market movements. The market is paying a colossal premium here. It's essentially pricing in 3 more quarters of 73% NNRAR growth before it's even been delivered.
But that premium is justified by the quality and, I think, the purity of the business model. CrowdStrike delivered total revenue of $1.23 billion, a robust 22% year-over-year increase. And crucially, they generated $296 million in free cash flow, which results in an exceptional 24% FCF margin.
That is a strong number.
It is. And when you look at high-growth SaaS companies, we use the Rule of 40 framework, which combines the growth rate and the profitability. For CRWD, you have 22% growth plus a 24% FCF margin. That equals 46. That confirms their elite status as a Rule of 40 constituent. It means they achieve highly sustainable, balanced growth without just burning cash. And importantly, 95% of their total revenue is subscription-based, which confirms the purity and predictability of this high-margin SaaS model.
That's a compelling financial profile, and I wouldn't argue against it. But the immediate trading behavior surrounding that stellar news, it suggests that market structure can override operational strength, at least in the short term. I want to highlight the specific price action on December 3rd, 2025, so the day after the earnings. The stock initially gapped down at the open to near $497.99. It was a classic, knee-jerk sell the news dynamic.
Right.
But then it quickly ripped right back up to the $515 level in this sharp V-shaped recovery. That kind of volatility and that kind of speed, a rapid $18 reversal, that is driven far more by instantaneous market mechanics and high-frequency hedging than it is by, rational, slow accumulation based on a deep reading of NR metrics. The volume profile in that rip tells the whole story.
I'd argue that speed merely reflects the urgency of capital flowing towards scarcity, which brings us right to our first key point of contention, this idea of growth scarcity versus the valuation ceiling. I maintain that the 73% NRAR acceleration justifies that 28 times PS premium because it signifies that gross scarcity is being monetized. And the reason for that success is their platform consolidation strategy, which is evidenced by the Falcon Flex pricing model that has successfully driven the ARR from adopting accounts to over $1.35 billion, an astounding 200% year-over-year increase. This shows deep enterprise penetration.
Sure.
This success, coupled with an 81% subscription gross margin, creates tremendous long-term leverage toward their stated 30+% operating margin target. The market is paying a premium for guaranteed superior long-term unit economics and the promise of that massive operating margin expansion.
While the 81% gross margin is spectacular, we have to temper that enthusiasm with the law of large numbers. CrowdStrike's ending ARR is substantial. It's at $4.92 billion. They are rapidly approaching that $5 billion scale threshold. The mathematical difficulty of sustaining growth over 20% becomes, exponentially harder at this scale. The current 28 times multiple assumes sustained, massive cross-selling success across every new module and, crucially, zero macroeconomic deterioration. That expectation of flawless execution is it's unrealistic.
But how so?
Well, specifically, to maintain that 20+% trajectory as they cross $5 billion, they need huge wins in areas like international expansion, which, still lags a bit behind their domestic success. And they need aggressive adoption of newer, non-core offerings like identity protection and cloud security. If the magnitude of the beat and raise simply diminishes, say they only beat estimates by 5% instead of 10%, the valuation premium will erode rapidly, regardless of whether the company stays cash flow positive. It's a binary bet on sustained high-magnitude acceleration.
But the market recognizes the difference between a pure software agent model like CRW and these hybrid competitors like PanW or Fortinet, FTNT, which still carry exposure to slower growth hardware or appliance risks. The software purity and consistently high gross margins justify that pricing differential. It signals confidence that they can convert those gross margins into industry-leading operating margins over time. That 28 times multiple is signaling what the market believes the company will look like when it hits $10 billion in ARR with 30% operating margins, not what it looks like today at $4.92 billion.
That is a very future-looking narrative. But let's shift the focus to the market structure itself, specifically this pervasive misunderstanding around off-exchange trading, which I think is a major contributor to the non-fundamental volatility. We often hear rumors of manipulation related to so-called dark pool trading data. Data from December 1st, 2025 showed the off-exchange short volume ratio for CrowdStrike at 55.04%. That's a massive amount of volume being executed away from lit exchanges, which, in the retail community, often fuels these rumors of institutional price suppression.
And this is where clarity and precision in our language are absolutely essential, and I want to leverage your point here. I agree the 55.04% off-exchange ratio is high, but we must remember this is a structural feature, not some conspiratorial maneuver. It largely reflects high retail participation. Investors placing small orders via their brokers, which are then routed through wholesale market makers like Citadel or Virtue. It's a practice known as internalization.
Right.
And yes, the sheer volume creates psychological uncertainty among less sophisticated investors. But for an expert audience, the distinction must be made. This high daily short volume is a transactional necessity for market makers who are hedging their exposure to all those retail buy orders. It is not evidence of a directional bearish sentiment aimed at suppressing the price.
Okay, I agree that focusing on high daily short volume is often a distraction from the real measure of bearishness, which is true directional short interest. However, Even if we accept that the high off-exchange volume is structural and just reflects retail internalization, the sheer fact that more than half of the trades are routed off-exchange creates an information asymmetry. This heavy reliance on internalized flow provides structural tailwinds for high-frequency trading activity, which can exploit these dynamics. It adds a layer of non-fundamental, short-term volatility that really benefits algorithmic players over the long-term holders. So while it may not be intentional suppression, it certainly affects the transparency and speed of price discovery.
But let's look at the true directional signal. CRW's true short interest, that's the number of shares committed to a bearish directional bet, is only 2.80% of the float. That is by far the lowest among its Tier 1 security peers. For comparison, PANW is typically above 6% and FTNT is around 3.3%. So that low directional short interest is the strongest bullish signal you could ask for. It tells us that the smart money, the institutional traders with billions on the line, they are afraid to hold a directional short position against the momentum that's generated by that 73% NAR. They'll hedge intraday, yes, but they are not willing to bet against this company overnight. That low number is the key takeaway, not the noise of the daily transactional volume.
I'm not convinced that a low short interest fully mitigates the risk that's inherent in that valuation. Instead, let's discuss the final point, which I think provides the most mechanical explanation for that December 3rd volatility: the mechanics of the gap and rip price action and the role of the options market.
And I'll maintain that the initiation of that gap and rip phenomenon was fundamentally driven by informed retail buy-the-dip sentiment. The market community, they recognized that 73% NAR growth signal, and they saw the initial drop to 497 as an immediate gift. Their opportunistic accumulation provided the initial strength for that rebound.
Speed of that V-shaped reversal were mechanically amplified by the options market structure, specifically the gamma component. We have to look at the options open interest. Leading into the earnings report, there was significant open interest in call options at these key psychological strikes: $500, $510, and $520. So when the stock gapped down below 500, the market makers, who are typically short these calls because they sell them to directional speculators, they saw their delta exposure rapidly change.
And what does that mean for the audience?
Well, it means that market makers need to maintain a neutral risk position. When the price begins to move back up toward those strikes and it started moving rapidly toward the 505 max pain level, which is the price where the maximum number of outstanding options expire worthless, the market makers were forced into aggressive mechanical buying. This is delta hedging, which can quickly turn into what's called a gamma squeeze.
Precisely. The market maker who is short a call option must buy the underlying stock to hedge their risk as the price rises. That mechanical delta hedging provided the immediate, non-fundamental fuel for the rapid ascent from 497 back up to 515. The options market structure didn't just support the fundamental bounce, it mathematically amplified the speed and the magnitude. This confirms that microstructure, rather than pure fundamental belief, provided the immediate velocity needed for that sharp recovery.
Remains. The stock closed that gap because the underlying business strength, that overwhelming 73% NARR acceleration, it provided sufficient confidence for the initial buyers to step in and initiate the movement that then triggered the market maker buying. If the earnings had been weak, that 497 dip would have likely turned into a capitulation, not a V-shaped recovery.
It required confidence, yes, but the key distinction is that the speed was unnatural, and it was unsustainable without that structural amplifier. It demonstrates that any movement away from that max pain level, whether it's up or down, gets snapped back by frantic hedging activity. This adds a layer of non-fundamental risk. The stock is volatile simply because of its popularity in the options chain, which that 28 times multiple does not adequately account for. That volatility is a tax on the investor, regardless of the quality of the underlying business.
To summarize my position then, CrowdStrike remains a high-conviction growth asset, and I think its premium valuation is fundamentally justified by its scarcity of growth. The reacceleration to 73% NARR, the structural competitive moat provided by the Falcon Flex platform, and the elite profitability confirmed by the Rule of 40 status All of these signal a high-quality asset worthy of capital flow preference over its hybrid peers. The complex price dynamics, including that post-earnings rip, are simply a reflection of the capital urgency to own pure-play software winners who have successfully decoupled from the broad market slowdown.
My summary is that investors must exercise extreme caution here. The high valuation of 28 times PS prices the stock for flawless execution, making it highly susceptible to disappointment, even if that disappointment is just relative to impossibly high expectations. Furthermore, the immediate price action is demonstrably influenced by market structure forces, specifically options gamma dynamics and that high rate of retail flow internalization. Understanding these non-fundamental risks is essential because they are the variables most likely to generate rapid volatility and potential multiple compression.
The material clearly provides robust arguments supporting both sides of this equation. CrowdStrike is undeniably structurally fortified by its business model and its operational execution.
But it's also mathematically priced for perfection when you view it against its peer group.
Exactly. And the interpretation of whether those powerful fundamentals or the complex and amplifying market dynamics will dominate the future trajectory, that remains the critical variable for forming a successful investment thesis here.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.